U.S. inflation stopped falling almost as soon as the Fed started cutting interest rates last September. This is a reminder that the Fed does not have a crystal ball. What would the Fed do now that inflation expectations are climbing once again? And two-year inflation break-evens are at their highest level in 2 years. It goes without saying that the Fed cannot make a U-turn without looking stupid. But the Fed also has good reasons to be concerned about Trump's tariff threats. It is almost certain that businesses will be quicker to react to any increase in tariffs than during the trade war under Trump 1.0. COVID proved to businesses that they can get away with raising prices when everybody else is doing it. The Fed has not said so explicitly, but I suspect that they would agree with me that the pass-through from tariff into inflation will be much higher this time around than during 2018 and 19. Also, last time around, China was the main target of Trump's tariff. This time, Trump is threatening to go after all trading partners, large and small. The potential product categories to be covered under new tariffs are also much wider. What all this means is that if a trade war were to break out, there will be less room for substitution. If there's any comfort for the Fed right now, is that the stock market seems to have become more sensitive to trade war talks than the bond market. If an all-out global trade war were to result in a significant correction of the stock market, the resulting tightening of financial conditions would help provide an offset to the shock to inflation, thus reducing the need for the Fed to raise interest rates. This is why a trade war is more bearish for stocks than it is bearish for bonds, at least at current levels of the stock market and inflation risk premium in the bond market. 2 weeks ago, I was less concerned about the risk of an all-out trade war. This was because I thought the European Union would do anything and everything to keep Trump engaged in the Ukraine war, including giving in to him over their trade disputes. I am now less sure. Trump's recent pivot to Russia and his promise to reduce commitments to NATO are straining cross-Atlantic relations, making a trade war more likely. I think this is very bearish for the stock market, especially the German stock market. Bonds would benefit from the negative growth impact of a trade war and from their safe haven status. I continue to think that bonds will outperform stocks over the next 3 months, at least on a risk-adjusted basis.